Understanding perpetual inventory systems, pros, cons, and implementation. In modern inventory management, a perpetual inventory system is becoming the industry standard for many businesses seeking efficiency, accuracy, and real-time insights. This article delves into the benefits and drawbacks of these systems, as well as guidance on when and how to implement them effectively. Pros and cons of perpetual inventory systems. Advantages. 1. Real-time updates. The perpetual inventory system allows businesses to maintain an accurate and up-to-date record of inventory levels. Every transaction, whether a purchase or sale, is recorded instantly. 2. Informed forecasts. By providing continuous visibility into inventory levels, companies can make informed decisions regarding inventory restocking and demand forecasting. 3. Ease of financial statement preparation. The real-time nature of this system enhances the accuracy of financial statements, as inventory valuations and cost of goods sold, COGS, can be readily generated. 4. Multiple location management. Businesses with multiple locations benefit from centralized data, enabling streamlined management and oversight across various sites. 5. Cost reduction of downtime. Continuous monitoring prevents loss of sales due to stockouts, thereby minimizing operational downtime and keeping the supply chain running smoothly. Disadvantages. 1. Cost. Implementation can be costly, particularly for small to medium-sized businesses with limited budgets. The technology required, including software and hardware like barcode scanners and POS systems, can require significant initial investment. 2. Hacking risks. With systems reliant on digital technologies, businesses face cybersecurity risks that could compromise their sensitive inventory data. 3. Stock loss and improper tracking. While the system tracks inventory levels, businesses still face challenges in monitoring losses from theft, damage, or errors unless periodic physical counts are performed. 4. Physical inventory still needed. Regular cycle counts are necessary to validate the accuracy of the perpetual system and identify discrepancies in inventory records. When to use a perpetual inventory system. A perpetual inventory system shines in particular business scenarios. High-volume retailers. Businesses such as large retailers that have a constant flow of inventory and a wide range of products benefit significantly from real-time inventory updates. Multi-location businesses. Companies with more than one location can streamline inventory management, ensuring uniformity in operations and better data consolidation. Growth-oriented enterprises. Firms anticipating growth that currently do not require complex inventory management may find it prudent to implement a perpetual system in preparation for future demands. Influencing factors. Several considerations determine whether a business should adopt a perpetual inventory system. Margins and affordability. Businesses need to assess their profit margins and budget to ensure they can sustain the costs associated with implementation and maintenance. Inventory size. The larger the inventory, the more advantageous a perpetual inventory system will be in facilitating effective management. Vendor responsiveness. Companies need to evaluate if their suppliers can adapt to a system that relies heavily on real-time inventory management. How to use a perpetual inventory system. To successfully implement a perpetual inventory system, businesses must follow these key steps. 1. Set up an accurate inventory database. Every piece of inventory must be cataloged in the inventory management system. 2. Leverage technology. Use POS terminals, barcode scanners, and robust software solutions to automate data entry, ensuring accuracy in sales and inventory levels. 3. Employ cycle counting. Utilize cycle counting methods, which involve periodically counting a portion of the inventory for accuracy comparisons against perpetual records. Inventory management techniques. Businesses can utilize various inventory management techniques alongside a perpetual inventory system. Economic Order Quantity, EOQ. This calculation helps determine the optimal order quantity that minimizes total inventory costs, including ordering and holding expenses. Importance of COGS and gross profit calculation. One key advantage of implementing a perpetual inventory system is the continuous generation of COGS, which can be calculated with the following formula. COGS equals BI plus P, EI. Where BI equals beginning inventory. P equals purchases for the period. EI equals ending inventory. Gross profit calculation. Similarly, gross profit, which reflects the profit a company makes after deducting COGS, can be computed in real time. Gross profit equals revenue, COGS. This continuous tracking offers companies vital insights into profitability and aids in strategic financial planning. Comparison: Perpetual versus periodic inventory systems. The essence of a perpetual inventory system lies in its real-time tracking capabilities as compared to a periodic system, which relies on regular counts at set intervals. Key differences. Transaction recording. Perpetual systems record transactions in real time, while periodic systems require physical counts at determined intervals. COGS details. COGS in a perpetual system is available immediately, facilitating instant financial analysis, whereas periodic systems provide this information only after inventory counts. Conclusion. The shift towards perpetual inventory systems is evident, particularly among large companies with extensive inventory needs or multiple locations. While there are significant costs and challenges involved, the advantages of superior accuracy, timely information, and operational efficiency make perpetual systems a worthwhile investment for many businesses. Smaller companies, however, may still find value in traditional periodic systems, although the trend is leaning towards more adaptable, real-time solutions that promise considerable long-term benefits. As businesses continue to grow and adapt, understanding the landscape of inventory management will be crucial in navigating the complexities of supply chain demands.